Hello, my name's Holly Mackay and I'm Managing Director of the Platforum. I'm delighted to be joined today by Hugo Thorman. Hugo's the CEO, of course, of Ascentric Wrap. Hugo, thanks for coming to chat to me today. Just before we sort of kick off, Skandia came out today and announced their new pricing strategy. Were you surprised by it? And generally speaking, where do you see platform pricing headed?
First of all, hello, Holly.
Hiya.
Thanks for having me. And I wasn't surprised by it. Obviously, we've been anticipating it. It pretty much reflected what I would have anticipated, I think. I think against their current pricing structure, it probably looks more competitive for larger cases, which would imply, I haven't actually run the numbers yet, which would imply it's probably more expensive for the smaller cases. Or of course, Skandia are keeping less, one of the two. So it's pretty much where I would have expected. I think it probably means that that's it for now, because implementing pricing changes is quite difficult, I think, for platforms. It's not something you do trivially and regularly, and in fact, it's very rarely that one does see changes in price. So I'd say this is a sort of sticking point. For the meantime, I've already on record for saying the general trend, I'm afraid, is going to be downwards, but I've also said that should be shared by fund managers, who I think genuinely anticipate that as well, and potentially even advisor charges.
Really? Because we generally will sort of hear across the market that the advisor charges are actually heading up rather than down.
They're heading up from the commission model. There's no doubt about that, but as I've again said before, my feeling is that advisors are doing more, providing a much wider and deeper service for their charge, so that justifies the charge actually going up, but it will go to a level and stabilise, and then I believe efficiencies, which we all need to provide, by the way, and we can talk about that, efficiencies will tend to then lower the charge they need to make, and hopefully competition. I think there should be competition in the market for clients, and generally competition will bring that price down as well, but there's no doubt about it, the pressure will be felt first of all by platforms and fund managers.
Okay. We talk a lot about price, I'm guilty of that. Like, if we can sort of turn the sort of discussion to value, or to making sure that a platform is the right fit for a particular type of client. If you think back, gosh, even 5 years ago, probably you were sort of starting to go out and talk to advisors, and the messaging then was really, we are a wrap, we think Mr. or Mrs. Advisor, you should have a platform, come and talk to us. Now the way that we're marketing wraps, I think, has changed, and advisors are starting to think, should I have all my clients on a platform, or should I use some off-platform sort of strategies? And if I am using platforms, how many do I need? Where do you sort of see things playing out?
Well, I think there was a time, you're right, where certainly advisor firms, you can understand why, wanted all their clients on one platform. And then, and I think they're right, the FSA made it clear you have to make sure the platform's right for the client. And by the way, going back to pricing, one just needs to be clear, we are talking about just a few bips here. This isn't going to change dramatically the wealth of clients, a difference of 5 or 10 bips. But let's forget that for the moment. I mean, in principle, it's right. You should make sure the right platform for the right client. So that old sort of chestnut of segmenting the clients and making sure for your segments the platform is appropriate, I think is a good way to go. I'm not sure that sort of broking the whole market for each and every client and then picking out of 20 platforms is wise, and hopefully no one's going to do that. So I expect to see it settling to, in use, only 1 or 2 platforms at a time. And again, it depends on the homogeneity, it's a nice word, isn't it? Homogeneity of of the client base. And on the one hand, because obviously that naturally means that one platform will suit more clients. But also, whether you've got a broad offering on the platform that you're considering, and obviously I would plug our own here by having access to a wide range of products, pretty much all investments, and also then a wide range of product wrappers. Then that's got to widen the spectrum for that homogeneous type of client. So you can be less homogeneous, if you will, and suit more clients. So I think it's the functionality and the breadth of the product offering playing off against the price. And does that cover all your clients? That's the analysis you have to undertake.
But to pick you up on the product issue you raised, I mean, Ascentric has gone out, and one of your probably the most important differentiator from word go has been you saying we will facilitate you, Mr. and Mrs. Advisor, to get access to a whole range of third-party providers. But the experience you've had is actually different to that. The experience you've had is advisors who have perhaps sold or have bought into Ascentric because of that concept. When it comes to it, you're finding that more than 50%, is that right, of your flows are going into your own vanilla tax wrappers?
Yeah, I mean, but you see, if you think about it, that goes exactly the same for investment. Platforms have said in the past, but you don't need 1,500 investments. You don't even need 1,000, because actually advisors choose Invesco Perpetual Income every time. But the fact is, of course, some advisors don't, and that's exactly the same with products. The majority will go for a standard range of funds, and the majority go for a standard range of products. But at the outside, there are advisors or clients, of course, for whom a different mix, a different fund, a different investment solution, and a different product wrapper is the right way to go. And as you know, we've got, I don't know, it's certainly over 25 other SIP providers, all of whom do business with us or through us. Because advisor firms work well with those SIP providers, or they find it's right for their clients, and that they're still operating now. The same with offshore bonds. We have our own offerings which do very well, but actually we provide we don't make it any easier for our own proposition than we do for third-party propositions. So they all seem to do quite well.
We talked earlier about pricing. Probably you said we're in a sort of falling sort of pricing market. Surely it must be much more expensive to run a proposition where you're feeding off to 20 different SIP providers than
we don't find it. We were always challenged. Some of my competitors challenged us initially on how we did it, and to be frank, I don't know why others can't do it or don't do it. We don't find it significantly more expensive at all. I mean, yes, there is another process that has to be undertaken, and I suppose if you hadn't grown that way, you wouldn't start that way. But we grew that way, and we're very happy to maintain it. It doesn't change the cost base of any significance at all.
Okay. One thing that might change your cost base is the new bit of a proposition you're working on, which is B2B2C. Now that's a real mouthful.
Yeah.
Basically, helping advisors deliver an execution-only bit of a proposition to their customers. How, when are you planning to launch that, Hugo?
Well, it's I'm afraid quite a lot more complex than we thought. I believe others will feel the same thing. It's quite a more significant build perhaps than we'd originally anticipated, and I think we'll struggle to do it by the end of this year. It's more likely to fall into early next year, to be frank. And that, as I say, is due to the complexity of the build. As you will have observed, there's not exactly a rush of these propositions. I suspect others have had the same difficulty. It hasn't put us off the area at all. I think it's going to be very, very important strategically going forward. At the moment, advisors are completely polarised on it. There are those advisors, for very good reason, who say it's not for them. They get their introductions from professional, from accountants and solicitors, and why would a direct proposition help that sort of model? And others who are very, very keen to promote it as part of their holistic proposition to a wider customer base, where perhaps younger family members are coming up through the direct channel and who will become advised, and those who advise will eventually become self-directed, depending on how much time they've got, because that's the sort of thing that drives what clients actually want in the end. If they've got time, they spend more time doing that sort of thing. If they haven't, if you're in, well, certainly in my position, haven't got time to do it, I'd rather have somebody else did it.
Yeah.
So that's the.
Yeah.
And I think that goes for a lot of potential clients. Yeah.
And how do advisors make money from an execution only proposition?
Well, that's one of the things one's got to work through, and again, anticipating the way the FSA are going to think about this. The regulator has views. Clearly, there is something that can be done with introduction. There's no reason why a charge can't be made for that. It's the ongoing charge that is most that should be chargeable, and it's how that is explained and how that is earned and justified is obviously through investment selection, through providing risk tools. There are tools that can be provided by the advisor effectively to the client for which they can charge, and obviously we're pulling that together, but it is actually being provided by the advisor and they can charge for it.
It feels quite risky to me, Hugo. I think if I were an advisor looking at this and weighing up the potential revenue stream, and I'm a big believer in execution only sitting alongside advice propositions. The research we've done with consumers says that people do want a multi-channel approach. They do have pots of money they don't want advice on. So I believe in the logic behind it, but I think if I were an advisor looking at this, I'd feel a bit nervous. Am I getting into a grey area? How can I manage the risks?
I mean, there clearly are risks because it's not sort of written down, it's not in the COBS rules, it's not clear exactly how it will. Obviously, a lot of the indicator will come from some of the current B2C providers who will now have to split out their services. Yeah. So they're going to act as a model anyway on a much, much larger scale than we're anticipating for very many years to come. So obviously we'll be watching with keen interest what happens in Bristol, and exactly how that unfolds. Come the end of rebates. But that won't be until, of course, to the end of 2013, the beginning of 2014. Well, we know whether they change the model before then. That will be interesting to observe as well. So I think it will evolve. There are definitely, advisors who are quite happy to share that risk with us. It's not. There are services they provide for which they ought to be able to charge for, and there's no question of doubt about that. The risk, funny enough, we've got to be terribly careful, isn't it? Of course, we share that very strongly, is making sure there's no misunderstanding about what's advice and what's execution only. And we have to be incredibly explicit. This is not advice. You're going to the platform and then you execute yourself and you're making your own decisions. And you can do that through the journey. You're just making it clear all the time. You are making this decision. You do realise this, Mr. Client. You're making the decision, no one else is. But that doesn't mean you can't be helpful along the way with risk-rated portfolios, for example, which can be provided by the advisor with all the information, but of course invested in by the client. Okay.
Well, will you come back and show us once it's ready to launch? Once you're ready to press the button.
I can hopefully show you something before then, but it'll obviously we'll be promoting it. We'll start off slowly. I mean, the fact is, as you've rightly said, it's an interesting area. A lot of advisors at the moment are quite rightly say, well, I'll see how it develops. We will be, you've got to be in early to develop the market. You don't have instant understanding of this thing, so we want to build our own expertise in this area. But we believe it will get traction very quickly because people will just see how it can enhance the brand of the advisor practice and, of course, add to the value of it.
Well, thank you for coming and talking to me. It's always a pleasure. And we'll no doubt catch up about your B2B2C, or maybe you'll have a new name for it by then.
Well, we'll have to think of something a bit catchier than that. It's a bit clunky, I know.
Okay, well, I'll get the
thank you. It's a
thinking
pleasure to be
going.
here.
All right, thanks, Hugo. Bye-bye.
Thank you, Ollie.